Looking at markets now, shares in Asia were largely lower as technology stocks in the region came under pressure amid rising U.S. bond yields. Technology stocks whose future earnings are less attractive to investors when yields are higher tend to be hit when rates rise. In Hong Kong, Tencent fell 4.3%. The Chinese tech giant announced that it will be divesting 2.6% of its equity in a company called Sea. Meanwhile, looking at European markets, they largely followed the negative trend that we saw in Asia. U.S. Treasury yields are rising at the fastest pace in the new year, and this is the fastest pace that we've ever seen in about 2 decades. That 10-year yield important because it influences mortgages and many other business and consumer loans. And basically, when bonds sell off or yields or interest rates go higher, investors generally tend to move to different other asset classes. So investors in this particular case waiting for the December Fed minutes to give an indication of where things are going to be right now. The central bank announcing last month that it would speed up its tapering, its bond buying program, and also factoring in interest rate hikes for 2022, 3 of them to be particular. But to talk to us more about what is happening, we are joined by Han Tan, who is from Axity. Han Tan, thank you so much for your time. When you look at the global market sentiment right now, I mean, how would you describe it?
Indeed. I think global markets are very much aware and cognizant of what you had just explained to your viewers earlier, the prospects of 3 rate hikes by the Fed within this calendar year, and with the first potentially happening by March, but markets are pricing it to happen by May, right? So, and as you very aptly put it earlier, I think the trajectory for not just Treasury yields, but U.S. rates would then be a force of reckoning for global investors and how they allocate funds for the coming year.
For the past couple of days, whether you're looking at the Financial Times or any Forex-related news, you see the news around the Japanese yen and how it's performing against the dollar. What's the significance of a weaker Japanese yen at this particular point?
Indeed. So when you look at the Japanese yen and how it's hit was weakest against the US dollar since 2017, I think it really speaks to the divergence between those central banks, right? On one hand, as we mentioned earlier, you've got the Fed that's looking to get ready to raise interest rates in the US. But then on the other hand, you've got the Bank of Japan that is still very much stuck in its pandemic era stimulus measures and seemingly far behind or lagging behind its G10 peers in terms of normalizing their policy settings. All right, so I think that divergence is very much playing out in the dollar yen, and of course, Treasury yields also weighing on that currency pair as well.
So when you look at the FX market, I mean, how do you think it would react to a sort of, balance sheet reduction as opposed to interest rate hike?
Indeed. So keep in mind that the balance sheet reduction has been going on for a bit now. It started off in November, and as you pointed out earlier, its pace was doubled last month. So I think markets had taken that in stride. Keep in mind tapering what had been spoken about almost ad nauseum in the markets over the past 12 months or so. Now it's about the Treasury yields response to the prospects of rate hikes, and finally, after perhaps some sluggish 6 months or so, you've got Treasury yields behaving like they're expected to in light of the prospects of those rate hikes, right? So I think for 10-year yields, if we see it hit 1.8% over the next few weeks or months, then I think that would be the signal to lean harder into that stronger dollar story.
So following the OPEC Plus meeting, what do you think will be the overriding idea for oil in 2022?
Yeah, for oil prices or for oil markets, I think it's still very much a demand-led story. Various market agents from OPEC Plus down to the average Joe with his or her car well, they want to see, prices, right, and prices reflecting the state of demand. So a lot of the gains that we have seen in oil prices are now conditioned on the idea that global demand is strong enough to absorb these incoming supplies, be it from OPEC Plus or from governments that are releasing some of their strategic reserves, right? So I think, long story short, it's still a demand side led story, and that informs how suppliers then react to it, whether they pump out more or pull back, in light of pandemic-related developments.
Overall, when you look at the markets, what do you think is still the biggest unknown right now?
Yeah, so besides developments surrounding the battle against COVID-19, I think markets are willing to look past that. I think the biggest unknown right now is when the Fed will be comfortable with raising interest rates, and also looking beyond that, whether or not that could be a mistake. Right? Because even while Treasury yields have been climbing, the spread between some of these longer dated Treasuries are perhaps not as steep as one would expect them to be. So it suggests that there is the risk of not just the Fed, but also the Bank of England, perhaps raising rates too fast, too soon in order to get ahead of consumer prices, but at the risk of breaking something, i.e. their respective economies. And if that happens, that could then ramp up the prospects of a recession, who knows, perhaps in 2023, right? So I think that's the unknown right now, and that's what markets are contending with, and are set to continue doing so over the coming months.
Han, thank you so much for your time. That is Han Tan, who is the Chief Market Analyst at Axinity Group, talking to us about the latest market developments. We're going to take a quick break, and we'll continue with news right after this.